if we start with a bit of the context, Bloomberg has covered this in extensive part, but let's remember where we are. Coming from Norway, it's very easy to think that EV charging should really just happen. However, this has really not been the case across the rest of Europe, especially when we look at the trajectory of how the EV sales have happened in some of the larger markets with potentially slightly lower median income, such as Germany, France, and the UK. Like any industry that is in its development, typically we see that there is a follow through the S-curve. What we are looking at is how different type of customers are ultimately buying the vehicles over the period of the past few years. And the key for the industry is how to get, especially in the larger mass markets, through the BEV chasm. And this is related to ultimately how the industry is able to provide a consistent regulatory support environment, which we have seen, especially in Germany, to be on and off. How affordable, sufficient, and also profitable the models can be for the OEMs. The extent of the charging accessibility, both in terms of numbers, but also whether the charger is accessible or not, and the underlying charging user experience, which many of us driving the BEVs will concur that it's not quite consistent yet. However, going through the 2024, that especially in Germany has experienced actually a dip in the BEV adoption, I believe that all of us are much more optimistic about what is there to come. And therefore, also as Stratgent, we are positive about the development. And as you would be able to read in our EV charging outlook, we truly believe that whilst there's, the curve is not necessarily a straight line, it is expected to go forward, especially with what is happening on the right-hand side. The many of you that are here at this conference are representatives of all the companies that are trying to make and access the value pools that we have in EV charging. It is truly impressive to see the diversity in hardware manufacturers that we have counted over 100 in Europe. Being in Germany, the number of the CPOs being over 1,000 shouldn't be a surprise with all of the Stadtwerke and others, but indeed it's a lot of players going after this, as well as software and value-added service providers, such as AMPECO. It's a lot of companies that are trying to chase the good luck. The bruising experience over the past couple of years, when the curve has not just continued to rise, has led to a number of companies actually exiting or scaling back the adoptions. So where are we? Are we in a process where coming forward, these numbers will be structurally much lower? Is there actually any profitability to be made in the EV charging ecosystem? We track over 80 companies and their financial performance. What you're looking at are graphs that show the revenue growth over the past couple of years against the EBITDA development in three main categories, being the hardware, being the CPOs, as well as owners, and the software companies. The samples are, of course, a bit more limited on the software side, as companies are still in the early stages of development, but there are certain trends that one can observe already from what is there. Hardware manufacturers have scaled their operations and their cost base in the expectation that a lot of the demand will indeed come, and now are facing a period when the growth is not stagnating, but going down in its absolute rate, and also the profitability going down ever so slightly. Whilst the CPOs that we track, both in terms of the public fast charging as well as in other segments, are able to increase the profitability, albeit from much lower part. It may also not be so fair to be judging the CPOs, especially those investing in the hard infrastructure, on purely EBITDA. You need to be seeing EBITDA, of course, from the expectation of the deployment of the capex that you have made. Nevertheless, EBITDA is still a part of the picture that one needs to look into. And software, whilst we have a few observations there, is indeed in the scaling phase, and we expect that it should improve going forward. When we look at the backing behind the companies that succeed, we see that there is a continuous appetite amongst a range of investors, those being the venture funds and growth funds investing in some of the software solutions, as well as the infrastructure funds investing in the typical CPO model. And we see that there's been an evolution of the funding that comes. On the CPO side, the charge point operator and owners, there we have moved from what one could categorize as corporate risk equity capital. You can think of the likes of Fortum and others investing in companies like Recharge, being able to successfully sell these to infrastructure funds who are not only able to provide the equity, but given the nature of the infrastructure of EV charging, increasingly more bank funding is happening. You would have seen the announcements from Ionity raising over 600 million euros, from Electra raising over 200 million euros this summer alone. It's pointing to an ability of the underlying business model to showcase traits of underlying infrastructure type of investments that more investors like. And ultimately, we will be moving towards what we would consider a pure infrastructure models, which will attract even more financing. When it comes to the software and value-add services, it's really impressive to see AMPECO's investment into this event, which might as well be the reason behind their ability to raise now the Series B this summer. And it's a really great example of a company that has been able to showcase the growth and get the backing behind it from the Series B. Monta is another one. You would see others, such as Virta and others, who are able to raise a growth funding. And we would expect further interest from your typical private equity and other type of investors moving into the space behind the select few companies that are indeed able to showcase a good profitability. If we look at some of the reflections we have done on businesses, in this case, the CPOs, that are profitable and what they do well, we can distill it into 4 key aspects. The first one is around the location strategy. And the panel before me was speaking about the utilization and the need for this, and ultimately, if you achieve the good utilization, you are indeed on a good trajectory towards further profitability. When it comes to the location strategy, that can drive indeed the utilization. It is important to secure the key sites early, but also with the underlying right contracts. There are a number of CPOs currently in the market trying to raise funding, where one might not have as good contracts as some of the others, and indeed are struggling to raise financing. Versus others, such as Ionity and others, have been able to really showcase, be there early, with the right locations to truly showcase how the utilization can ultimately scale. One thing is locations. The second thing is to deploy the capex and ultimately the cost that you have related to it at the right time. And for this, we have been working with a number of the CPOs to deploy truly data-driven approach, understand how potential location can perform, and there is a lot that one can utilize from the data from EcoMovement and others to truly underpin a good selection solution. The second part comes with regards to making a customer-centric, and I would add to the digital also physical solution and integration. What you find with the different locations is that amenities and drawing the users to that location for ultimately more than just charging is really important, both in terms of the dwell time attractiveness, but also then working on the digital experience that people have with regards to routing, as well as how payments and availability is visible. And optimizing this experience is really, really key. The third one comes from managing the cost base. Being a CPO is actually quite costly when you think about it, from securing not only the initial sites and deploying that CapEx, but then also having the operating costs from energy, running and paying for software, including drives, AMPECO and others, and driving that operational excellence. End-user pricing is a key. Tesla is showing us how this is done from really dynamic perspective, and many are looking how to do this in the best way. CPOs are not only in the charging business, they are increasingly also moving to the new revenue streams, those being how to optimize the dwell time revenue with your location partners, but also how to enter into flexibility markets and beyond to optimize the entire ecosystem and further. The fourth one is related to what we just discussed about what type of financing one is able to attract. We have seen from the public fast charging a great use of the bank financing on top of the equity investments from the various infrastructure investors. Now we also see that that is available for other CPOs in other segments, where banks and others are really able to roll the infrastructure investments also in other segments. When we turn this around from the CPO, what are then the considerations for the hardware manufacturers, both for the public fast as well as the home charging? Coming from Norway, having both Zaptec and Easy coming from Norway, it's impressive to see the growth that they've been experiencing, as well as a number of other hardware manufacturers throughout Europe and beyond. Here we have ultimately three key observations what distinguishes good from the great when it comes to the hardware. The first one is design the hardware with truly lifetime value. Hardware is hardware, but ultimately recognizing that there is a lot more how the charger is being used in that wider ecosystem is important for the hardware manufacturers to recognize and to take the fair share of the pie that is available and increasingly available from the ecosystem, especially when one considers that the electricity usage as a result of having a BEV at home can grow by almost a half. The second one for the hardware manufacturers is related to having a strong focus on the sales channels and the partner network development. It is to some extent still related to the ecosystem play and realizing who is best placed to sell the ultimate hardware to the end users for the hardware manufacturers. But having a clear strategy on this is very important to not lose also the value at the end. Thirdly, we have seen that the profitability of a number of the hardware players has decreased, especially as they have increased their cost base in that great anticipation that the market will come, which is now coming back, but potentially at a slower rate than many have expected. It's important to consider the in-house capabilities versus the contract manufacturing, and ultimately securing the quality control. I think that many would confess here, including Elevate and others, having multiple hardwares to manage, that the quality can vary quite greatly, and those that are profitable are able to manage this very well. With this, I would love to encourage you to download our EV charging outlook that we published just before the summer. We are positive about the market, and the revamp we have seen in the first half of the 2025, that this will indeed continue. We are also positive that the select few companies that are truly thinking about the key value levers are able to attract in the market the right funding with the right partners going forward, and that ultimately EV charging has a place in the wider ecosystem. So with this, thank you.